To recap kind of what I thought about 2024, I was optimistic the housing market wasn't going to collapse. I think Dave kind of hit on some reasons there. We did not see a big collapse in housing prices. The market still remains, the housing market specifically remains a very tough market for affordability purposes. And I think where I was wrong about kind of that prediction in some ways is even though it didn't collapse, I really expected the home builders to really ramp up building and really increase the housing supply through new builds. Because as Dave laid out, no one is moving from their dream mortgage. We don't have dream homes anymore. We have dream mortgages.
Mm.
And what we've seen a lot of, and I wrote about in our unfiltered piece at the end of December here, is instead of moving, people are tapping into home equity line of credits and the equity they have built in their house to renovate their house instead of so they can keep that mortgage and only pay a higher interest rate on, a smaller portion than for fully moving their mortgage to 7%.
Mhm.
But I think, because the housing market remains so strong, my other prediction was I was pessimistic that inflation wasn't going to come down. So my other prediction was inflation wouldn't come down as aggressively as people thought, meaning interest rates were going to be staying higher for longer. And spiritually, again, I was right, I would kind of say in that regard, because at some points we saw the market having 6 rate cuts priced in for 2024. Like for some reason, the market was convinced that whether inflation was either going to come down aggressively or the economy was going to go into a major recession. And in either of those scenarios, the Fed was going to respond by just chopping rates aggressively. But really, none of the data, I think Dave, you said it there at the end in 2025, like the data's not pointing to a recession right now. So if there's no reason for the Fed to cut, they don't need to cut. And they
Mhm.
ended up the year cutting more than I think I would have expected at the start of the year. I'll call it 4 standard cuts, but 1% overall, a standard cut being about 25 basis points. They started with a 50 and then 25 and 25. And really, I think the final 25 at the December meeting really got the markets in line, which is kind of what Aaron was talking about with, the markets and the Fed are now aligned with. We saw a pullback in stocks and rates move higher in December because the markets finally realized the Fed don't fight the Fed and the Fed isn't inherently wrong. The markets and the Fed are in this constant balancing act, and people always thought the Fed was wrong. The Fed was behind the curve. The Fed was this, the Fed was that, but they engineered a soft landing. Rates are at a stable-ish level, let's call them at this point. And kind of, looking at it, what that does is stable rates allow people to plan. CEOs, business owners, now don't have to be thinking about, well, if rates go from 0 to 5, I can't really plan my investments. I'm going to wait for them to come back. Well, after a year of little movement, I think we do see economic growth, economic stability kind of out there with the ability to plan. And inherently, people think higher rates are bad, but we got to remember, why do we have high rates? We don't have high rates because inflation is at 9%. Inflation's come down to about 3 and is trending slightly lower. And the US GDP is at 2.7% estimated for 2024. We haven't got the final numbers yet. So we have above average GDP growth, which if you look back to 2000, GDP growth averages about 2.1%. We're going to have 2.7% in 2024, so higher than the GDP growth of 2023. We have a strong labor market where people have jobs. I don't know if having higher rates is a bad thing for the economy when you have a strong economy. I think where it can get a little dicey and where I don't, again, now this is where I'm going to align myself with Dave. I don't like making predictions, but I'm actually very much aligned with what he thinks is going to happen in 2025. I don't see a recession out there based on the data right now. I think the biggest kind of unknown or question is what will the impact of tariffs be? So, and Dave, I think that's maybe where you and I are a little bit different minded, and I could see a big impact from the tariffs one way or another, whether it's bringing more manufacturing onshore if we do have high end tariffs, but that's going to drive up worker wages and worker wages cycle into inflationary impacts. I think you could see some element there. It's not necessarily the price of goods themselves are going to go up, but the amount that we're going to have to pay the labor force contributes to that inflationary cycle. And usually, when you get a increase, that drives inflation higher a little bit more longer term. Because rarely, when the inflationary pressures abate, you know, you don't ask for a pay decrease all of a sudden. Once you get that increase, it's pretty sticky. Well, if the price of Cheerios goes up, well, once the supply chain or the kind of the inflationary impacts work themselves out, the price of Cheerios can come back down a little bit. So I think that's the kind of major thing that I'm going to say. I don't see a recession with an asterisk unless we get the aggressive tariffs across all aspects of the economy, from Canada to Mexico to Europe to China. If we have a trade war on every front, I think that's a little bit scarier. If it's just used as a negotiating tactic, Dave, like you said, I think that could be actually very beneficial in some ways, where we can maybe even out the trade policies because there are some unfair trade practices overseas. And so hopefully we don't see inflation coming back because Fed rate hikes and its shift in Fed policy from maybe, stable rates to now raising rates. That's the nightmare scenario for 2025. But at this time, I think the Fed can stick to their plans of 2 rate cuts in 2025. The markets, and Dave, I think you said it just recently, as of a Friday on January 10th, when they got the recent job report, turned that down to one. So the market is now pricing in less cuts than the Fed, which is a good thing for stocks because I personally think we're going to get about 3 rate cuts in 2025. So I think we'll have the ability with inflation coming down, a strong economy to cut a little bit more than people are anticipating, which should help kind of alleviate that pressure on stocks. I think why you've seen so much kind of declines from December and into the new year is rates are bumping up on that 5% mark. And that's just a scary mark in people's minds. If higher rates immediately makes people think stocks need to go down. But remember, we have higher rates for good reasons. Strong economy, strong labor market, strong housing market, and really all those kind of factors really do bleed into what I could see as a very strong economy in 2025.